As you might have noticed from the soaring real estate prices, grocery prices, and even car prices, inflation has been quite a significant issue in the past few years. Currently, the inflation rate is around 3 to 4%, but in 2022, it went as high as 9.1%. Millions of Americans are feeling the effects of inflation, and for many of these people, it's getting harder and harder to afford everyday necessities. As a response to inflation, the IRS released new inflation-adjusted tax brackets on Thursday, November 9th, 2023. Today, I'm going to break down these new tax brackets as well as the changes to the standard deduction and everything that you would want to know as it pertains to your taxes for 2024. Without further ado, let's dive in. All right, guys, here are the tax brackets for single filers in the United States. If you're making income between $0 all the way up to $11,600, then you're going to be taxed at a 10% federal tax rate, okay? So this is the very first tax bracket, and there are 7 federal tax brackets, which brings us to tax bracket number 2. If you're earning income between $11,601 all the way up to $47,150, you're going to be taxed at the 12% tax bracket. So the 12% tax bracket actually is one of the smallest tax brackets compared to the 10% tax bracket. Let's jump to tax bracket number 3. If you're earning income between $47,151 all the way up to $100,525, you're going to be taxed at the 22% tax bracket. This is actually where a majority of taxpayers fall into. The median income in the United States is roughly around $70,000. So most taxpayers pretty much are going to have a majority of their income taxed at the 22% tax rate. But that leaves us 4 other tax brackets. The 4th tax bracket will tax your income between $100,526 all the way up to $191,950 at a 24% tax rate. So the 24% tax rate only covers income from $100,526 up to $191,950. After you make over $191,950, all of your income now is going to jump into the next bracket. So income between $191,951 all the way up to $243,725 is now going to be taxed at a 32% tax rate. So now if you're getting more successful, the income that you're earning is going to start getting taxed at higher tax rates. But not all of your income is subject to 32%. Only income between these two numbers, $191,951 up to $243,725. Let's jump to tax bracket number 6. If you have income between $243,726 all the way up to $609,350, now you're taxed at the 35% tax rate. This is where we start getting into the top 1% of income earners. They're earning income between, let's just say, $250,000 all the way up to $609,000. This income is going to be taxed at 35%, which now leaves the last tax bracket. Any income over $609,351 is going to be taxed at a 37% tax rate. So 37% is the maximum tax rate that you can be taxed at, and you're not in the 37% tax bracket unless you're making over $609,351 as a single filer. But you will come to know that the married filing joint tax brackets differ greatly than the single tax brackets. Let's go over married filing joint next. For those who are filing married filing joint, the income brackets are almost double. If you're earning income from $0 all the way up to $23,200, you're taxed at a 10% tax rate if you're filing married. Now, this is just the first tax bracket for married filing joint. The second tax bracket starts off right at $23,201 and goes all the way to $94,300. This is the 12% tax bracket. If you're a married couple earning $94,301 all the way up to $201,050, you're going to be taxed at the 22% tax rate. Now, if you happen to have income that exceeds $201,051 all the way up to $383,900, you're going to be taxed at the 24% tax rate. And if you're married making income in excess of $383,901 all the way up to $487,450, you're going to be taxed at the 32% tax bracket. So you start to see that the 32% tax bracket bracket ends at $487, but for single filers, the 32% tax bracket actually ends at $243,000. So you have the ability to jump into the 35% tax bracket a lot quicker, depending on how you're filing your tax returns. Let's jump down to bracket number 6 for married filers. If you're earning over $487,451 all the way up to $731,200, now you're at the 35% tax bracket. So just getting into the 35% tax bracket is a lot harder for a married filing joint couple as opposed for someone who is a single filer. And that also means that getting to the 37% tax bracket means that you have to earn over $731,201 to be in the 37% tax bracket. So if you're married filing joint and you haven't reached $731,201 yet in income, you're not going to be in the highest of tax brackets. And this is why it's always beneficial to run the numbers to determine if it makes more sense to file as married filing joint versus filing as single. I'll say probably 9 out of 10 couples that come to my office are typically filing married filing joint unless the other spouse has some previous tax debt or is trying to qualify for a student loan interest deduction. But then again, that's only a $2,500 deduction. So many clients are typically filing married filing joint. Now let's jump to head of household. Now that we are on head of household, it's important for you to know that not every taxpayer qualifies to file as head of household. If you are married, legally, you should not be filing as head of household. You really only have 2 filing statuses, married filing separate or married filing joint. However, if you are supporting qualified dependents and you're single, this is a situation where you can claim the head of household deduction and you'll receive a greater tax deduction and more favorable tax brackets than if you were to file single. Let me share with you the head of household tax brackets. Number 1, if you're earning income between 0 all the way up to $16,550, you're going to be taxed at a 10% tax rate. Now, if you're making more than that, and let's just say you're earning income between $16,551 all the way up to $63,100, this income is going to be subject to a 12% tax rate. And if you're making over this amount, let's just say between $63,601, you have all the way up until $100,500 of your income being taxed at the 22% tax bracket. Now that leaves us 4 other tax brackets to go. So if you're making over 100K and let's just say between $100,501, your tax bracket at the 24% will extend all the way to $191,950. This is pretty good. Let's jump down to tax bracket number 5, which is the 32% tax bracket. And at this point, you guys are aware that we have 3 left, the 35% and the 37% tax bracket to get us to a total of 7 tax brackets. So if you're earning over $191,951, you have earning potential all the way up to $243,700 that will have you subject to a 32% tax rate. But as soon as you cross over $243,701 all the way up to $609,350, you're going to be taxed at the 35% tax rate. And that means that anything over $609,351 is finally subject to a 37% tax bracket. So here it is. These are the tax brackets for head of household. And if you're head of household, that means you have a qualifying dependent that you're claiming on your tax returns, which allows for you to qualify for this status. Many people should be claiming head of household if they are taking care of a dependent because it allows for more favorable tax rates. Next, we're going to go over how there's been other changes to the tax code, including the standard deduction. I just want to remind you that the United States uses a graduated tax rate system, which means that the tax rate of a particular tax bracket does not apply to the entirety of your income. It only applies to income within the limits for that particular bracket. Tax rates get higher as your income rises from bracket to bracket. So for example, if you're a single filer, the first $11,600 of income you will have will be taxed at 10%. The next $35,549 of your income will then be taxed at the 12% tax bracket, and so on and so forth. And this is how the tax brackets work. Now you might be asking yourself, will the IRS continue to make inflation adjustments to the tax brackets? As long as inflation continues to exist for the United States dollar, it's almost certain that the IRS will continue to make inflation adjustments to tax brackets every single year. So you should expect to see inflation adjustments to the tax brackets next year, the year after that, and the year after that, and so on and so forth. But what about the standard deduction? Now that we've gone over the tax bracket changes for 2024, I just want to go over exactly what the standard deduction is in case you don't know what it is or how it works. The standard deduction is a large tax deduction that most people who are not going to itemize itemize their deductions are eligible for. In other words, it's an alternative to itemizing your deductions. The way it works is that you are allowed to subtract the standard deduction amount from your taxable income, and this reduces your taxable income significantly. For example, if you're a single filer making $100,000 and you take the standard deduction, it would reduce your taxable income to $85,400. That's quite significant. So what does this all mean for you? Well, when the IRS makes inflation adjustments to the tax brackets, it tends to make them slightly easier for people from a tax perspective. And this is because it means that you'll have to make more money in order to get pushed into a higher tax bracket. So in other words, when the IRS makes inflation adjustments to tax brackets, it can mean that you will end up owing less in taxes than you might have otherwise if you make the same amount of money in 2024 that you did in 2023. This is because the tax brackets get pushed up, not down. To understand this, let's go over a quick example. Okay, so let's just say in 2023, you made $100,000. In this case, you would have fallen into the 24% tax bracket as the final tax bracket that your income would be subject to. But now that you're making the exact same money in 2024, which is $100,000, you're actually going to fall into the 22% tax bracket. And the reason why this is the case is because the IRS has inflated the tax brackets. As you can see, this would result in you owing significantly less in taxes due to the IRS inflation adjustments. Now, why does the IRS make inflation adjustments? I get asked this all the time. So the IRS is well aware that the cost of living increases significantly due to inflation. So people's everyday lives tend to get way more expensive. The IRS will adjust the tax brackets in order to account for inflation increases to keep the playing field relatively level. So in other words, the IRS knows that inflation hurts people financially, and thus it makes periodic adjustments to keep tax brackets fair, considering how much inflation has occurred. Now, you might be wondering, does everyone move into a different tax bracket when the IRS makes inflation adjustments? And the answer to this question is no. And this is really important, guys. Earlier in this video, I explained how you would fall into a lower tax bracket for 2024 if you made $100,000 in both 23 and 2024. However, if you made $110,000 in both of these years, then you wouldn't really move any tax brackets. And that's because the $110,000 would have landed you into the 24% tax bracket in 2023 and 2024. So no, not everyone automatically enters a new tax bracket when the IRS makes inflation adjustments to the tax brackets. Well, we've covered quite a lot of information, but here are some of the key points that I want you to remember when you walk away from this video today. Number one, the IRS makes regular inflation adjustments to the tax brackets, and it released its new inflation-adjusted tax brackets in early November. Number two, the IRS's inflation adjustments could push you into a different tax bracket and affect your marginal tax rate. And number three, the IRS will most likely continue to make inflation adjustments to the tax brackets for the foreseeable future. But here's the thing, if you have any questions about inflation adjustments to the tax brackets or any other topics that I covered in this video, then feel free to get in touch with my company by clicking on the link below in the description. You can also find a link to my tax alchemy course in the description. This is where I teach you advanced tax strategies used by the wealthiest of Americans every single year to reduce their tax bill. Finally, you can find a link to get in touch with our real estate tax strategy team. For many of you, it might be a great year for you to start investing in real estate in 2024, and I want to make sure that you're doing so with offsetting your active forms of income. Thank you so much for finding this video and for following me. If you haven't already, go ahead and like and subscribe, and I look forward to seeing you on the next video. Cheers.